When it comes to finding opportunities in the market right now, our next guest says steer clear of utilities and large cap value, bullish instead on select tech and industrial mid caps with an eye on rolling recessions hitting a variety of different industries next year. Joining us here at Post 9, Citi Global Wealth Chief Investment Strategist Stephen Wieting. And it's an interesting idea to not just worry about overall recession, but rolling recessions in industries, because what you hear and what I've tried to capture from certain companies and industries is very different, whether you're in housing or in travel.
Well, absolutely. And look, 2 years of below trend growth feels awful, but it's going to accomplish what a shallow 6-month recession will. You know, I think that the labor market, which has outgrown the economy last year by the most since 1974, is heading to a slowing next year. I think profits, which fell over the last 12 months, are going to gain some ground. It's probably going to take 2 years rather than 1 year to get that big 12%. So it's going to be longer. And rolling recessions, you know, you talked about real estate for a moment. Multifamily housing, it's about to deliver 1 million new housing units. All of this was planned 3-4 years ago at zero rates. That's a piece of the housing market and real estate that's going to weaken the economy next year. But trade, manufacturing, single-family housing, these are all deep in what looks like a very recessionary contraction.
So play the stocks according to how industries are impacted by rising rates?
You know, when I think about like today, this is a bad market. We're getting tightening financial conditions. What the Fed does is it raises yields, it lowers stock prices, it pushes up the dollar, all of that. But it's going to give us a good entry point. And when I think about that, the fact that growth stocks outside of the very largest ones have been left behind. We're talking about for mid-cap profitable growth companies, not the ones with the highly leveraged balance sheets in banks and REITs. But again, those growth companies that don't have a lot of debt are trading at about 15 times trailing earnings. The 25-year average is 21 times. That is very rare to find an asset that's trading cheap to its own history. And look, around the world, when you have bond yields in Japan and Europe that are not about to join the 5% club, we can use some of our asset allocation over in U.S. assets like SMID, even if the environment isn't wonderful.
Russell's closing in on a 20% drawdown. You're interested in small caps as well?
We are interested in small caps, but being specific that Russell 2000 works when we've had that V-shaped collapse in the economy. Some of the firms just managed to survive, and then they bounce back a lot. We were overweight Russell 2000 in 2021. That's not where we're going to go yet. We're going to go in a lower risk, growthier, higher quality version of small caps. And again, you can do this with S&P 400 and 600 industries. And again, if you shift away from banks and financials, which could have their day, I think you can find that there are a lot of areas. Cybersecurity companies, again, as an industry that are not, trillion-dollar behemoths that are really growing. And really outperforming what could be a 5% yield.
What about healthcare? Where does that fit in there? Typically defensive, not performing too hot.
Well, this is the thing. Pharmaceuticals were our largest industry overweight last year. 2022, stock market's down 20%. U.S. pharma was up mid-single digits for the year. Everyone crowded it and sat in it. They could perform a bit in a down market, but it's still a relatively crowded trade for us. When we think about taking risk for the next 2 years, medical equipment looks like something that it's been beaten down. And these are not only, again, unprofitable companies.